Hilton Worldwide posting an earnings beat supported by strong travel demand. The stock is up more than 5.5%, 11% for the year now. Joining us is Hilton Worldwide CEO Chris Nassetta. Good morning, Chris. Welcome. You talked on the call about favorable trends continuing. Tell us a little more about what you're seeing.
Yeah, thank you, Sarah, and hey, David and Carl. Nice to be with you guys. We're really pleased with how we finished last year. Obviously, the numbers were good, but what was really driving it was sort of all of our segments, whether that's leisure travel, business travel, meetings and events, did better than we thought. We had the best year that we've ever had in our history in terms of unit growth. We opened more than 2 hotels a day last year in the world, and all of that drove really solid bottom line performance. We had record levels of EBITDA, 11% growth in EBITDA. And importantly, your question, like, how does that translate over to this year? We feel really good about how it's translating. We're early in the year, but the trends across all the major segments from a same-store point of view appear to be very solid. And we finished last year with the largest pipeline that we've ever had in our history. We have 500,000 rooms of hotels around the world in our development pipeline. So we feel really good about unit growth as we come into 2025, and for that matter, as we look forward a few years. And so, we have a lot of optimism, obviously, pleased with last year, but focused, as most people are, on how that all is going to translate into delivering another great year in 2025.
When it comes to growth, I think you've been focused on luxury, lifestyle, right, Chris? That's where you've leaned in. Is that paying off?
Well,
is that where the growth is?
I would say we've been focused everywhere. So last year, about half of our growth came in luxury and lifestyle. We signed a huge number of deals in that space, but we're really a very balanced growth story. Luxury and lifestyle is really important everywhere around the world, but so is the mid-market. And if you look at where the growth is going to come from over the next 3, 5, 10, 20 years in terms of the numbers, meaning the room counts, growth opportunity around the world, it will come more from the mid-market, just because it stands to reason. What's going on in the world is middle-class growth. And what middle classes can afford are mid-market brands. And so it's all important. I mean, at the lowest level, lowest price point, Spark, we have terrific growth, and that is being extended all over the world now as we move that brand into the other regions of the world, all the way up to Waldorf Astoria, where we're going to have some incredibly iconic openings for Waldorf this year. And most importantly, and near and dear to your guys' heart, the Waldorf Astoria New York is going to open this summer, which we're very excited about.
Finally. Well, how's pricing?
Finally, yeah. I'll have to take you on a tour. It's extraordinary.
I remember the old Waldorf. How overall does pricing look with such solid demand? What's the outlook there?
Pricing is strong. I would sort of say, so goes inflation broadly, so goes pricing, in our industry. So I think we expect the year that we'll have not extraordinary pricing growth, but I'd say modest pricing growth, sort of in the 1% to 2% range, sort of in line with broader inflationary pressures sort of diminishing, but strong, because, as you point out, demand is strong. And every segment will be a little bit different. I'd say meetings and events, given the demand there, you'll see much greater rate pricing power, but broadly across all segments, we see pricing going up.
Chris, is the industry, would you argue, in a expansionary capacity mode at the moment?
It is, but it's Carl. I think that's you, Carl. It's a constrained environment for obvious reasons in most places around the world. But focusing in the biggest hospitality market in the world, the United States. There's a lot of people that want to develop, and certainly we're getting more than our fair share on the development side, but the cost to build hotels has gone up in a significant way. Obviously, interest rates are still relatively high. Financing is available, but not, in significant ways, although that is improving, but still somewhat constrained. And so, in a way, the industry is sort of in a very sweet spot, meaning demand growth is quite good, as I already described, and supply growth, capacity growth, while people want to bring capacity on, and we are trying to expand as an industry, it's running at historically low levels of about 1%. So that creates a very healthy environment for the industry. Now, I'm here to talk about Hilton. The important thing is we do better than the 1% because our brands, we have 24 brands, are the best performing brands in the industry. We're more financeable than our competitor brands broadly. And so we get, in the end, a disproportionate amount of the capital that is available for both new builds and conversion opportunities. And so that's why when you see us post a number last year, we're growing last year at 7.3%. The U.S. market grew, at 1%. So we are, we have sort of a multiplier effect that's a result of, unique sort of attributes of Hilton, which is we attract capital to build hotels because people want to get higher returns, and we have been delivering higher returns for our owner community.